Hi everyone, and thank you for tuning into my channel where I talk about stocks, the stock market, and investing. If this sounds like something you want to get more of, subscribe down below. Alright, in today's video, it's going to be another segment in my series of how to read financial statements. And what I do in this series is I go through a step-by-step reading of a financial statement for how I would do it if I was a beginner. Now, keep in mind, I have a master's in financial economics. I've passed all 3 levels of the Chartered Financial Analyst program, and I've been a professor of finance for several years. But I'm not going to go into all of that any of those advanced things that I've learned in those processes. I'm going to try to break it down, simplify it as easily as possible so that if you're interested in investing in Nvidia stock and you don't have a financial background, you can go to their financial statement and read it and get some information and gain some value out of it. All right, so let's get right into it. So here is their Form 10Q, which is their most recent quarterly statement. Typically, every publicly traded company will report quarterly financial statements and an annual financial statement. So this one is its quarterly financial statement for the period ending on July 31. Okay, so as you scroll down here, you're going to see a lot of jargon. You can just skip over, and you're going to see the table of contents here. So for a beginner, I wouldn't advise going through every step and every page of this financial statement. I wouldn't do that, okay? I would just focus on, for Nvidia, going into item 1, which is their financial statements, and then item 2, starting page 23, okay? So let's get right into it, starting with page 3. It's financial statements, and I've highlighted a few segments here, and let's get right into it. So companies need to report an income statement, a balance sheet, and a statement of cash flows. And so let's look at each one of those, taking a little time to walk through them all. So Nvidia reports revenue, and they show their 3 months ending on July 31. They also show their results for the first 6 months of the year. So they give you the most recent 3 months, and they give you the most recent 6 months, and they give you last year's figures so you can compare this year's with last year, so you can see if they're growing, what's going on with the business, and compare it to last year. That's informative because you not only want to know how the business did in this most recent quarter, you want to know how it did in the same quarter last year so you can compare it on a like-for-like basis. Okay, so Nvidia's revenue in its most recent quarter increased to 6.7 billion, up slightly from 6.5 billion in the same quarter the previous year. However, its cost rose significantly. It increased to 3.8 billion from 2.3 billion. So this is something I would want to make note of if I was following this company. Why did these costs increase substantially when revenue did not go up all that much? Okay, so that's a red flag. I'll make a note of this, and we'll see if we get an answer for that a little bit later on in the financial statement. And so because of that big increase in cost of revenue, the income from operations fell to 500 million, down from 2.44 billion in the same quarter last year. And similarly, in the 6 months ended, its income from operations decreased to 2.36 billion from 4.4 billion. Okay, let's look further down its financial statement, and we're going to get to, we can skip over this next one, and we'll get to its balance sheet as of July 31. And here you'll see the company's assets, you'll see their liabilities, you'll see how much cash they have, you'll see how much debt they have. And for Nvidia, they've got roughly 3 billion of cash on hand. That was higher than last year when they had 1.9 billion. Their accounts receivable increased to 5.3 billion, up from 4.65 billion, a considerable increase that I make note of. and also their inventories increased to 3.9 billion from 2.6 billion. So I don't like to see that for companies, their inventories increasing this substantially, especially when revenue is not growing that quickly, as we saw earlier with Nvidia. Revenue was not growing that much. And at the same time, accounts receivable increased. That could mean that more of its sales were made on credit rather than on cash, which lowers the quality of those sales, right? I mean, all of us would prefer to buy something if we got favorable credit terms. If we went to the store and we saw something for sale for $500 and we had to pay for it right now, we may not be as willing to buy it as if the store owner told us that we don't have to pay him until 3 months from now, or 4 months from now, or 6 months from now. If he gave us those favorable terms, we would be more willing to buy it. But at the same time, that increases the risk for the store owner that I may not pay them that money 6 months later when it comes due. So for that reason, I don't like to see accounts receivable going up this significantly, especially when sales did not go up proportionally as much. And I always like to look at a company's long-term debt. For Nvidia, we see here that long-term debt decreased from 10.9 billion at the same time last year to 9.7 billion this year. But we see short-term debt increased by the similar magnitude as long-term debt decreased by, which tells me that the long-term debt could have they could have refinanced some long-term debt into short-term debt, or that debt has 8 months remaining and so now it's categorized as short-term instead of long-term debt. So it's not like Nvidia paid down their overall debt. They've just shifted it from long-term to short-term debt. All right, as we move down, we're looking for its cash flow statement, which are the three financial statements I emphasize looking at, especially if you're just starting out looking at financial statements. And here is Nvidia's cash flow statement, and it's for the 6 months that ended on July 31. And what I like to see here is cash flows provided by operations, the one that's providing the majority of cash flow for the company. As you might imagine, if you're running a business, you want that business to generate cash from its operations, from selling products and making a profit. You can, of course, there's other ways you can increase cash for your business, and that is by just going out and borrowing more money. That would increase cash for your business, but that's not a sustainable form of increasing cash, and you'd prefer to increase cash by generating profits, not by increasing debt. So for that reason, I emphasize looking at cash provided by operating activities. And for Nvidia, its cash provided by operating activities decreased year over year to 3 billion, down from 4.5 billion last year. And the primary reason for the decrease was that it spent almost a billion more on inventories, which it still has on its balance sheet. So it still has those inventories because it didn't sell as much as it thought it was going to sell. So that caused a decrease in, one of the reasons it caused a decrease in the cash from operations. Another reason is that it prepaid expenses, so it had to prepay a lot of things up front, and almost 1.5 billion worth, and so that's another factor that decreased cash flow from operations. Another significant use for cash for Nvidia was that it bought back $5.3 billion worth of its stock. So a company, when management feels that its stock is undervalued in the marketplace, they go out and they buy back their shares, and in that way they use some of their cash to reduce the share count, and that means that the profits that remain are split among fewer shares, and it has the effect of increasing earnings per share. And so investors can be encouraged that Nvidia spent 5.3 billion buying back its stock. Overall, its cash at the end of the period was $3 billion. So at the same time last year, it had 5.6 billion in cash. Now it has 3 billion in cash. Okay, so we looked at its three prime important financial statements: the revenue, the income statement, the balance sheet, and the cash flow statement. So now let's go back up to the table of contents, and then let's jump to the second item I would advise considering, which is management's discussion and analysis, or in other words, item 2 here, page 23. And here's where you'll find a lot of explanation, a lot of discussion from management explaining why the figures are reacting in the way that they're reacting that we saw in the financial statements. So this is also a nice overview of the company and the business. It says Nvidia pioneered accelerated computing to help solve the most challenging computational problems. Since our original focus on PC graphics, we have expanded to several other large and important computational intensive fields. Fueled by the sustained demand for exceptional 3D graphics and the scale of the gaming market, Nvidia has leveraged its GPU, which stands for Graphic Processing Units, architecture to create platforms for scientific computing, AI, which is artificial intelligence, data science, autonomous vehicles, robotics, augmented and virtual reality. So that gives us an idea of what Nvidia does and the markets that it serves. Okay, and here Nvidia gives us some highlights about recent developments, and one major recent development was that on February 8, 2022, Nvidia and SoftBank announced the termination of the share purchase agreement whereby Nvidia would have acquired ARM, which is a business from SoftBank. The parties agreed to terminate because of significant regulatory challenges preventing the completion of the transaction. So regulators were making it difficult for this transaction to go through and reducing the probability that they would approve it. So SoftBank and Nvidia agreed to terminate the deal. That said, Nvidia recorded an acquisition termination cost of 1.35 billion in the first quarter of 2023, reflecting the write-off of the prepayment provided at signing in September of 2020. This is not a rare occurrence. Sometimes when companies enter into a purchase agreement, when they enter into an agreement to buy another company, there will usually be a clause in there that states if something was to prevent this transaction from completion, the acquiring company would pay the acquiree a certain fee for taking part in this process, right? So the company that's getting acquired wants to have some compensation for the risk that this agreement doesn't actually go through, because the company that's getting acquired is going through great pains to make this process go through. They're making different plans because they're expecting to be acquired, and so if that acquisition doesn't go through, they need to make some changes, and so there needs to be some compensation in the agreement just in case that scenario comes through. And this is exactly what happened with Nvidia and ARM and SoftBank, and so Nvidia had to pay $1.35 billion, which was unfortunate for Nvidia. Moving along, Nvidia gives us an outlook on how demand and supply is looking for its business, which is also informative. So let's go through this. I've highlighted several segments because Nvidia does a good job in explaining it and being transparent with its investors. So let's see what they've said here. So because we do not manufacture the semiconductors used for our products, we are dependent on third parties to manufacture and assemble our products. Our manufacturing lead times are very long, which requires us to make estimates of customers' future demands. So that could be a risk because Nvidia needs to plan 12, 18, sometimes 24 months ahead when they're planning customer orders. In the meantime, customer demand can shift significantly in that time frame, so Nvidia could end up ordering products and inventory that is not matching with what customers are demanding at the moment. Which isn't that what we saw earlier in their balance sheet when we saw inventories had increased substantially year over year? That could be this risk coming to fruition in that Nvidia ordered their inventories that they have right now. They went into agreements to order that inventory maybe a year or more in advance, and now that the inventories came, customer demand wasn't as high as they thought it was going to be, and so now they're stuck with this extra inventory. So that explains why inventory is elevated. So now we understand a little bit more about its business. They go on to say, we build finished products and maintain inventory in advance of anticipated demand in periods of shortages impacting the semiconductor industry, limited supplier capacity. As we have experienced in the past, the lead time on our orders for certain supply has extended to more than 12 months compared to historical lead time of approximately 12 months. In other words, we've all heard of supply chain shortages resulting from the outbreak from the pandemic, and that has caused Nvidia's lead times to be longer than historically. It used to be that they needed to make orders 6 months ahead. Now they need to make orders more than 12 months ahead of time. So that's increased their risk of not matching supply and demand. Our supply, which includes inventory on hand, purchase obligations, prepaid agreements, has grown significantly due to current supply chain conditions and complexity of our products. Purchase obligations and prepaid supply agreements represent approximately 3/4 of our total supply. So not only is the inventory on its balance sheet elevated, but they've also entered into agreements, purchase obligations. That means this is inventory that they must buy, and prepaid supply agreements that they must complete, and that's approximately 3/4 of its total supply. So not great news there. Not great news for Nvidia investors. Demand for our products is based on many factors, including product introductions and transitions, time to market, competitor product releases and announcements, competing technologies, and changes in macroeconomic conditions, including rising inflation. So all sorts of factors impact Nvidia's demand for Nvidia's products, and most recently these headwinds are causing demand to decrease, which we saw typically Nvidia has experienced healthy, very robust revenue growth, and to see its revenue growth slowing down in the recent quarter was a surprise slowdown. It caught management off guard. And they're warning investors that they're entering a time frame when they will transition architectures for their gaming and data center products, which might impair their ability to predict demand and impact our supply risk. So they're entering into a transition, which is increasing the risk of the business that they might order these products that may not match what customers want. So they might experience reduced demand for not only this new generation of products, but also the previous generation of products, because as you might imagine, if you're a customer in the market for a GPU and you expect a new one to come out in the next few months, you're not going to buy the old model when you expect the new model to come out in the next 3 months. So you're going to wait. And here's an interesting one, especially in recent times. NVIDIA's GPUs are designed for gaming, data center, professional visualization. Sorry, that was harder than I expected to pronounce. And automotive markets. However, in recent years, NVIDIA's GPUs have been used for digital currency mining, including blockchain-based platforms such as Ethereum and Bitcoin and other cryptocurrencies. So a lot of the demand for its GPUs was because they could be used to mine cryptocurrencies. So people were buying them in anticipation of mining cryptocurrencies to make money off of that process. But Nvidia goes on to say here that they can't predict how much of the demand for its GPUs is caused by miners of cryptocurrencies. So they don't know how much of their products are being sold to cryptocurrency miners, and they don't know how much is being sold to gamers using it for gaming. That's difficult for them to predict. But regardless, that exposes Nvidia investors to the risk that Nvidia's sales is going to be connected to cryptocurrency prices. So if cryptocurrency prices decrease, that will decrease demand for Nvidia's GPUs, and vice versa. If they increase, it could increase demand for Nvidia's GPUs. They go on to say in the second quarter of fiscal 2023, gaming revenue experienced lower sell-in of their GPUs. So they were selling less GPUs than they thought they would. The sequential decline in gaming revenue also resulted from the war in Ukraine, impacting sales in Europe and lockdowns in China due to COVID-19. The extent to which cryptocurrency mining contributed to the decline is difficult for them to predict. These recent reductions in demand and our reduced expectations of future demand have required us to record charges for excess inventory on hand and on order and cancellation and underutilization penalties. So they noted earlier that they entered into agreements where they promised to buy a certain amount of product, and now that they're experiencing slower than expected demand, they needed to cancel some of those orders. But in order to cancel those orders, they needed to pay suppliers, right? Because they entered those agreements. To cancel those agreements, they need to pay suppliers. Otherwise, those suppliers will not continue to do business with Nvidia if they just cancel their agreement and refuse to pay them. They say that potential future demand reductions could require additional reserves. So not only did they have to take a penalty on the existing inventory, we saw earlier that they still have elevated inventory, and they may need to take a further write-down if they need to discount those inventory prices even more just to get those products to sell. So this is a risk that investors should look out for. Moving on, I've highlighted this in red because on August 26, 2022, the US government informed Nvidia that they're imposing a license requirement effective immediately for any future exports to China, including Hong Kong and Russia, of our A100 and forthcoming H100 integrated circuits. The US government feels that it's a risk that these products may be used to military users in China and Russia. So this is a huge red flag, and it could cause Nvidia to not be able to sell their products to China, which is a massive market for Nvidia, of any of their next generation products going forward above this A100 and H100. So any new technology that comes out, you can reasonably expect the US government to not allow those sales to go through, because this technology can be used for military use cases, and the US government doesn't want a US company helping the Chinese government in developing its military, or helping the Russian government in developing its military. All right, so Nvidia is trying to work with its customers in China to mitigate the impacts of this change by the U.S. government. However, they do note that it could reduce sales by approximately 400 million in its next quarter. Okay. Another interesting note is that as the COVID-19 pandemic continues, most of their employees are still working remotely, and they've paused most business travel. So that's keeping expenses down. When the offices begin to reopen, they're going to experience incremental costs once people start coming back. They need to support those expenses, operate the office buildings. And so that's another potential increase in expenses that's coming up. I don't know if they're going to plan to do this in the next 6 months, 12 months, or 18 months, but whenever it happens, that's going to cause a lift in expenses. So it's another thing investors can be aware of. And again, during a pandemic, it's increasingly difficult to estimate demand and predict how consumer behavior is going to evolve because it's changing so rapidly. First there was lockdowns and people were extremely highly demanding options for entertainment at home, which included gaming, which created a surge for Nvidia's products. Now, as economies are reopening, consumers are rapidly shifting to spending money on away from home experiences like restaurants, concerts, movie theaters, and theme parks. And that's what's caused one of the factors causing a significant slowdown in sales of Nvidia's GPUs for gaming. And so these shifts are happening at unprecedentedly quick rates because consumer demand hasn't shifted this quickly in any historical time period. So it's hard for a business to manage these kinds of changes. Here's an interesting little chart that shows Nvidia's gross profit margin compared to revenue. And we see here that revenue had increased slightly from the same quarter in the previous year. But when we compare to the previous quarter, which was ended in May, revenue came down significantly from 8.3 billion to 6.7 billion, and its gross profit margin also decreased significantly from around 65% to 43%. And this is partly due to the write-downs that it had to take on the inventories because they have to decrease prices to get these things sold. So while the gaming division is struggling, gaming revenue was down 33% year over year. Its other segments are doing quite well. Data center revenue was up 61% from a year ago and 1% from the previous quarter. And as we move on, automotive revenue was up 45% from a year ago and 59% from the previous quarter. These increases were driven by revenue from self-driving cars and artificial intelligence cockpit solutions, partially offset by a decline in the older cockpit revenue solutions. So as cars are infusing more technology in their cockpits, in your consoles when you're driving, in your dash and all of that, they're using Nvidia's chips in those upgrades, and that's increasing revenue from those segments. So those other segments are doing well, even though its gaming segment is doing poorly in the recent quarter. And here you see the $1.2 billion charge for the inventory, and the charge consists of 570 million for inventory on hand and then 650 million for inventory purchase obligations in excess of their current demand projections and the fees they had to pay for cancellation and underutilization penalties. All right, here. And so the final thing I will consider here in Nvidia's 10Q statement is its concentration in revenue. Revenue from sales to customers outside of the United States accounted for 70% and 74% of their total revenue for the second quarter and the first half of fiscal 2023 respectively, and 85% and 86% for the total revenue of second quarter and first half of 2022 respectively. So the vast majority of business is, for them, it's outside of the United States, which that risk is elevated now that the US government is starting to become more restrictive in what it allows Nvidia to sell and who it allows to sell to. Who knows which country is going to be next where the government will perhaps create further restrictions. And so it's a good sign for investors that it's de-risking from that. Last year it was 85 and 86% of its revenue international sales. This year it was only 70 and 74%. So it's de-risked a bit from that. I'd like to see more of the revenue come from the US and North America more favorably. Okay, so we gained a lot of information from looking at Nvidia's 10Q statement. Even if you don't have a financial background, if you looked at these segments, you would have gained a lot of information and insight into what's going on with the business, why sales are rising, why they're falling, which segments they're rising, where it's doing business, where its markets. And so it's a nice look through for investors before they purchase a stock. So it gives you some information so that you know about your business that you're investing in, even if you don't have a financial background. So I hope you enjoyed this beginner series in looking at financial statements. Let me know your thoughts and comments below. Thank you for watching, and I'll see you next time for the next installment of Reading Financial Statements.
I want to thank the Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with the Motley Fool to bring you 10 stock picks from their popular Stock Advisor. Stock Advisor has beat the market by more than 250%. Go to fool.com/Parkev to get your 10 stock picks now.